The credit markets right now, like the equity market, are priced for almost 0% recession risk. How can anybody ever say at any moment in time that the business cycle's been totally repealed? You'll never hear that from me.
I think the economy and the credit markets are much more resilient now. The correction we had at the beginning of this year, that could be fairly concerning. Then we had this remarkable V-shaped recovery.
What the S&P 500 has done in gold terms, the S&P 500 is down 23% this year.
If you've got GDP being revised up and you've got the employment numbers being revised down, that must mean productivity is absolutely on fire. I've been calling it the roaring 2020s, and so far so good.
I'm pleased to welcome to my show two economists and strategists who have been very popular on this program and many others. Ed Yardeni, president of Yardeni Research, and David Rosenberg, president of Rosenberg Associates. Very honored to be joined by both of you. They have slightly different views in the markets and where the economy is headed, but are both brilliant nonetheless. Thank you for being here, both of you.
Thank you very much.
Yeah, thanks, David. Great to be on.
I just interviewed Ed, so let's follow up with Ed, and I interviewed David a few months ago, so we'll follow up on his views there as well. We'll have to talk about the government shutdown, which is ongoing this week. But first, let's just get your stock market prediction and then the macro views behind that prediction. Dr. Ed, let's start with you since I spoke with you recently.
Yeah.
You got updated your bullish outlook. First it was 8,000 points on the S&P by the end of the decade, and now you're saying 10,000.
Yeah, I changed that about several months ago, actually.
Yeah.
I started talking about 10,000, and basically the economy's proven to be amazingly resilient, and we've seen that in very strong earnings. Earnings were very strong in the first and second quarters, and just kind of thinking about the trend in earnings without a recession occurring between now and the end of 2029, I think we could get to 10,000. For the year ahead, I'm using 7,700. I think the market will be discounting $350 a share for the S&P 500 by the end of next year, and I would apply a 22 multiple on that, so that would get me 7,700 by the end of next year. And I think the market will continue to move higher. Valuation multiples are high, and I think they can stay high as long as there's no recession. And I think the economy's demonstrated the past 3 years we've had the most widely anticipated recession that just didn't happen. Maybe now that almost nobody thinks there's a recession coming, from my contrary instincts are a little bit on alert, but again, I'm going to go with a resilient economy for the rest of the decade. And I've been calling it the roaring 2020s, and so far so good, and just need to get a few more years right.
All right, David, I'll let you give your forecast, and then we can respond.
Right. Well, I don't give point forecasts anymore, and the reason is because the people that have point forecasts are continuously, revising them. And I think it just creates more volatility in their own lives as opposed to getting a point estimate right. Everybody was cutting their year-end targets during the February to April drawdown, and that was a mistake. And now everybody is raising their numbers. I don't operate in black and white. I operate in shades of gray, because the one thing I've learned in the 40 years in the business is that there is no such thing as a sure thing. And when you're giving a point forecast, you're basically saying there's a sure thing. I think it's more helpful, actually, when you give a point forecast, if you talk about what the risks are to your forecast, and they could be upside or downside risks, and what plan B is if the base case scenario doesn't come to be. So that's basically how I operate, but that's from years of having worked both on the sell side and the buy side. So I deal more with direction, and I spend most of my time across the asset classes trying to depict what's priced in at any moment in time, and then whether or not I disagree with what the markets are telling me. People always say that the markets are right, but were the markets right, in the summer of 2007? When you look at what happened, not just in the next year, but the next 2 years, just as one example, there's countless other examples. So sometimes you have to either agree with the market or disagree. And the question is, what's priced in? I think Ed hit the nail on the head when he said that nobody's calling for recession. And it is ironic because there was so much recession fear back when the Fed was tightening policy so aggressively in 2022 into 2023. And I think what a lot of us underestimated was the power of fiscal stimulus, and primarily not just the subsidies by the Biden administration, which were huge for the construction of manufacturing facilities. But it was really that $2 trillion combined stimulus checks to the household sector were the first time ever 100% of stimulus checks. And $2 trillion is not exactly chump change. All that money got spent, and it was a gift that kept on giving and served as a massive antidote to what the Fed was doing over that period. That's why the inverted yield curve didn't work this time. It was the power primarily of those stimulus checks, which are now basically in the rearview mirror. I would say that as far as the market's concerned, Ed is, in terms of his calls, has obviously hit the nail on the head. But I am concerned, when you have the multiples, and I think that Ed made the point that the multiples can stay elevated. I just don't know if the multiples only make sense if we're in the sort of real interest rate environment we had 5 years ago. Not in the real interest rate environment we have right now. You always have to take a look at, where the market's trading, any market, benchmarked against the risk-free real interest rate. And on that score, when I look at almost every multiple that you could come up with, price to sales, price to EBITDA, price to book, insofar as that still matters in today's environment. The Buffett indicator, that has its limitations too, but price to sales or price to sales. And you look at the trailing and the forward, and you look at the CAPE multiple, which is my favorite because it goes back more than 100 years. And when you're at 38 on the CAPE multiple, and it's not a timing device, but I always find that valuations, while not a timing device, at any point on the continuum either act as a tailwind or a headwind. We've only been this high on the CAPE multiple, the Shiller multiple, 3 other times in history, and it was back at the end of 2021. And nobody was calling for a bear market in 2022, but we did get one, and it was saved by ChatGPT in the fall of that year. And then you're back in 99, 2000, and before that, well, we're even above the level of 1929. Each one of these valuation metrics that I mentioned are more than 2 standard deviation events. I guess we could say that it's different this time, and maybe it is. Maybe ChatGPT and the shift in the technology curve is bigger than the internet was. Time will tell. But the point that I'm making is really 2 things. The first is that I don't normally go balls to the wall bullish on anything when it's trading north of a 2 sigma event. I just don't do that. I think we are in a bubble. And I think, as Bob Farrell famously said, bubbles go further than you think, which is where we are right now. But they don't correct by going sideways. And I just don't invest in 2 SD events, no matter what. I find other things to deploy the money, and we've been doing that. It's very interesting that as we're sitting here, the first thing we're talking about is the stock market. And I imagine we'll get into gold and silver. But gold and silver and the gold and silver mining stocks have actually smoked the S&P 500 this year, and they're not a trade on the Mag 7. They're a trade maybe on something else that's going on. But if you're taking a look at what the S&P 500 has done in gold terms, not in deflated US dollar terms, the S&P 500 is down 23% this year. So that, again, is if you're measuring it against something historically that's been stable, which is the gold price. If we're taking a look at what's priced in, I'll just make one last point that I said before, that you want to take a look at what's priced in. And when we back out the valuations, what we're able to ascertain is that the S&P 500 as its own asset class is discounting for the next 5 years, sort of 2030, is discounting 15% EPS growth on an average annual basis, which is double the historical norm. Now, maybe we'll get that. History shows there's a 1 in 10 chance that over a 5-year period, you'll get double the average growth rate in earnings.
All right,
the investors should know that is what you're buying right now. You're buying a market that's anticipating a 2x on the historical earnings trend benchmarked against the historical record.
Right now, gold is trading at an all-time high, which has far surpassed many of the most bullish forecasts for 2025. The gold price itself is up 46% year to date, while silver surpassed the $40 mark, a price not seen since 2011. Meanwhile, banks are still raising their gold price forecasts, with Goldman Sachs projecting $4,000 by year end if current buying continues, and $5,000 if the Fed aggressively lowers rates. Driving further demand for gold is strong central bank buying, with central banks' net purchases totaling 244 tons in Q1 2025 alone, according to the World Gold Council. Into this boom in precious metals and in record central bank demand, I believe I have just come across one of the most monumental and significant developments in gold and commodities that I've seen in recent times. Now, ETFs in the past have made good trading vehicles accessible to a much larger audience in the 2000s, in much the same way that Blockbuster branches made movies accessible to cinema goers. But here's the catch. The next revolution could make ETFs of today obsolete or greatly challenged, just like how Netflix and streaming services upended the video rental industry completely. ETFs face several problems, including high management fees in some cases, and a lack of trust in the auditing system in other cases. Today's sponsor is a company that aims to fix many of these problems and revolutionize the way commodities are traded. The company is called StreamX and is listed on the NASDAQ with the ticker symbol STEX. It's about to launch a fully backed yield-bearing gold product to be tokenized and launched on the blockchain. The platform itself was developed by the same software experts that built cybersecurity infrastructure for Capital One Bank, Bank of America, and JP Morgan's credit card processing infrastructure business. The token will be on the Solana and Coinbase's base blockchains, and as I've discussed on my show previously, the tokenization of real-world assets like gold is one of the most important and biggest financial disruptions of our times. The company has secured up to $1.1 billion in funding through a mix of equity, convertible debentures, and a line of credit led by Cantor Fitzgerald, the company that was run by Howard Lutnick, Secretary of Commerce, and now managed by his sons. This funding will allow the company to draw upon and purchase physical gold to back their products, as well as to likely add to their own balance sheet. Mining mogul Frank Dijkstra, whom I've interviewed in the past, has just invested heavily as well, owning 17 million shares of StreamX now and is serving as strategic advisor. The company has also attracted the likes of Mitchell Williams, a CIO who has previously served in executive roles at Oppenheimer Funds and Wafra Inc. StreamX seeks to be a fintech tokenization giant, basically. Do your own research on StreamX, which is going to be a major disruptor in the commodities and ETF business with fully backed auditing and verifiable ownership, redeemable and secured. Check out their website in the description, link down below. All right, thank you. I'll just let Dr. Ed have a chance to respond to the evaluations.
Yeah, look, I think David and I actually do agree on gold. I have never had an opinion on gold as an old-fashioned strategist. I don't have anything to any model that I can use. I need some income. I need interest, coupon, rent, something. But you don't have that with gold. And of course, there's a lot of explanations for why gold goes up or doesn't. It's traditionally viewed as an inflation hedge. But when it rose above 2,000 last year, I said, this could be the beginning of a bull market. And I based it on a very simple insight. Russia invaded Ukraine. The U.S. and Europe froze the assets of the Russians. And central banks of countries that are hostile to American interests decided it's time to buy more gold and cut back on their dollar and euro reserves. So there's basically a central bank put on gold. And then we've had a lot of geopolitical instability, which I think has been unnerving. I think Chinese investors are buying a lot of gold because they got killed in the property market. And the Chinese government hasn't really done anything to stabilize that market. They've gotten whipsawed in their stock market. So undoubtedly, you've got Chinese investors buying gold, and people in India have traditionally been gold purchasers, and I think there's a lot of demand coming out of there. I think you can throw in all sorts of other things about concerns about fiat currencies, debt crises. Yeah, I think David's right on with the gold call, and if gold works, silver works. With regards to the market, the question David, appropriately asked, well, what is the market discounting? And I guess from my point of view, I was in the minority camp on the economy for the past 3 years, arguing that we would not get a recession, that an increase in the Fed funds rate from 0 to 5.5% wasn't so much, it was partly tightening, but it was also normalizing. 0 was the abnormality, 5.5% was not abnormal at all. And the same thing went for my view of the bond market. 0.5% was the abnormality resulting from QE, the COVID, and factors like that, concerns about deflation when COVID hit. But now that we're at the 4 to 5%, I think that's back to normal. And so I think those levels of interest rates are sustainable. And I've been thinking that if the Fed continues to, I was opposed to the Fed lowering interest rates last year and this year because I said, look, last year I said the bond vigilantes are going to bite you. They're going to come back, they come and get you. And sure enough, they lowered the Fed funds rate 100 basis points last year, late last year, and bond yields went up 100 basis points. This time around, bond yields got down to 4%. They've kind of bounced off of that. They're kind of toying around with that level. But I don't expect to see bond yields going lower here. I think they're going to remain in this 4 to 5% range. So I think what the stock market is discounting, my interpretation, is there was a lot of, as David said, there was a lot of concerns about a recession over the past 3 years, the most widely anticipated recession that just didn't happen. The Godot recession is what I called it. And David's right, fiscal policy is a big part of the resilience of the economy, but the consumer, one factor that I think a lot of people have missed is the baby boom demographics. The baby boomers have always had a very important impact on the economy. And right now, total household wealth is a record $160 trillion. And half of that is held by the baby boomers, $80 trillion. So the baby boomers were raised by Spock. And I'm not talking about Dr. Benjamin Spock, though they were raised by their mothers who read Dr. Benjamin Spock. But we baby boomers kind of grew up watching TV, and we watched a lot of Star Trek. And Spock the Vulcan said, live long and prosper. And so we've taken that to heart. We've been living longer, and we've invested in all sorts of different assets, from houses to real estate to homes to insurance policies. And we've prospered. Along the way, we paid off our mortgages. So there's a tremendous amount of net worth that the retiring baby boomers are spending now. They're sharing some of that with their adult children, maybe helping out with mortgage down payments, mortgage interest, the grandchildren's, after school activities, whatever. There's a great deal of resilience in the consumer as a result of that. Great deal of resilience in capital spending. More than 50% of capital spending now is in technology, and I think that's based on the GDP numbers. I think it's actually more than that. And technology is something that companies recognize they have to spend on in order to stay competitive. We've got a shortage of skilled labor. We've got a shortage we've got a mismatch of labor. And as a result of that, companies are doing what they should be doing, and that is increasing productivity. So I see a productivity boom over the rest of the decade into the 2030s. If the roaring 2020s work out for me, I'll be talking about the roaring 2030s. But I think the stock market's discounting the resilience of the economy, and maybe erroneous. Now, as you said, David, now that nobody's expecting a recession, maybe now's the time to worry about it. But I think that's what the market is betting on. And the PEs, tend to will always go down when people worry about a recession, and you get a correction when the recession doesn't happen, and you get down to maybe 15, 18 from in the 20s. When a recession actually happens, you get single digit multiples in the market. And I'm not guaranteeing this. It doesn't come with a money back guarantee. But I think the resilience of the economy continues through the end of the decade. I think we have rolling recessions instead of economy-wide recessions. And I think the market's correctly discounting that.
All right, I'll move on to the labor market. I'll start with David first. So, private sector payrolls just went negative for the second straight month. Lost 32,000 jobs in September. June was revised to negative 13,000 jobs, the first loss since December 2020. The hiring rate is now at 3.2%. It's not a level similar to the immediate. It's now a level similar to the immediate aftermath of the Great Recession, and investors are betting the Fed will cut rates to save the day. Will the Fed cut rates to save the day? Will that be enough? I'll just let you comment on the labor market to start with, David. And going back to the no recession call, Jerome Powell himself has stated that the labor market is weakening. Is this a precursor to a recession, or is it just noise?
Well, I don't think it's noise. And, the reality is that, what didn't happen in the recession scare of 2022 and 2023 is that you were not seeing declines in employment that you're seeing right now. Now, we don't have a non-farm payroll report today, and we'll see how long that's going to take. But in the past 4 months, the only reason why non-farm payrolls haven't gone down is because of the skew of the birth-death model. And outside of health and education, which is non-cyclical, employment's been declining for the past several months. So you're seeing serious erosion. It's not noise, it's a pattern. You mentioned the ADP number. The first thing I go to with ADP is the small business sector, because the small business sector is on the front lines of the economy, and they can adjust their payrolls much more quickly than large companies. The small business sector employment declined 40,000 in September, which is huge. And that was after a 44,000 decline in August. We haven't seen declines like that since the summer of 2020, when COVID was still ravaging the economy and most of the economy was closed. And the small business sector is a leading indicator. And there's other things too, right? Like you've got the service sector. ISM employment has been below 50 4 months in a row. For manufacturing, it's been below 50 now for 8 months in a row. And as you had mentioned, from the JOLTS numbers, we're seeing on a trend basis a big decline in hiring activity. The Challenger numbers, for example, on hiring year over year, that's fallen dramatically. And I think this is important, the hiring rate going down. Because if, in fact, the other side of the debate is right, I'm not saying Ed is saying this, but a lot of people are saying that the decline in the labor market is supply side related because of all the immigration restrictions. I think that's a factor, but it's a two-bit factor. I think that there is a fundamental decline in the demand for labor, because if companies are scrambling to replace the people that are being pushed out of the country, you'd be seeing job openings going up. That's not happening. But you'd be seeing gross hiring activity going up, and that's not happening. And you'd be seeing companies scrambling, and in that scramble, they'd be raising wages. But wage growth is actually moderating. So we're seeing a fundamental erosion in the demand for labor. And I think it's obviously important because employment ultimately leads disposable income, and disposable income then leads consumer spending, and consumer spending is roughly 70% of GDP. Now, it may well be that the stock market looks through all this because, when you have $9 trillion mega cap growth companies, you have basically the same share of classic growth in the S&P 500 that you had back in the late 90s and 2000s. So by definition, the S&P 500 has morphed into a growth index, and it's lost a lot of its cyclical properties. So who knows? Maybe the first time ever we have a recession, the stock market just breezes by because it's effectively a long duration animal. It doesn't mean that's the same for the S&P 600 or for the Russell 2000, but that has been the case for the S&P 500. It's morphed into a growth index by definition. Therefore, it's got a longer duration expectation. I mentioned what's priced in on a 5-year basis. However, let me just say that for the people talking about GDP, it's not the only measure for economic activity. And we all talk about how so far this year, there's actually been no growth for 92% of the economy, called the part of the economy that isn't touched by AI directly or indirectly. 92% of GDP is actually flat so far this year. It's all been AI. And the same concentration in the economy as there is in the stock market. It's not just autos and housing. There's a lot of areas of the economy that are struggling right now. But the AI story is carrying the day. There's no doubt about it. But something else has happened that people that are saying the economy is so hunky-dory that actually in the second quarter, the biggest contribution to GDP growth was the tariff-induced plunge in imports. Imports went down so much in the second quarter, arithmetically, it contributed 5 percentage points to headline GDP growth because imports are a negative in the GDP numbers. So when they go down, it provides a huge boost to GDP. Outside of imports, real GDP was actually negative 1.2. Negative 1.2.
Well, David,
that's something that's worth commenting on. And the fact that the consumer has hung in very well, but you can't talk about the consumer in the aggregate really, because you got to take a look at what the critical factors are. The critical factor, and you can see it in the savings rate. The savings rate in the past 4 months has come down more than a full percentage point. Why?
David,
Why is that happening? It's because you've got the stock market boom. So you've got this ongoing K-shape to the consumer, right?
Yeah.
Like basically when McDonald's is telling you that people are skipping breakfast, you can't therefore then say, oh, well, things are hunky-dory with the consumer. There's a segment of the consumer, and it's the high end, that's driving the bus, and that's because of the stock market.
Okay.
It's not because of the labor market. And in actuality, I don't know anybody can look anybody straight in the face and say this is a great economy when in the April to August period, real personal disposable income, you want to talk about the labor market, what is the income after tax in real terms that the labor market is spitting out, David? Negative 1.2% annualized real disposable income growth. And yet real consumer spending growth is up 2.6% over that period. That's the fallout, is the drop in the savings rate, linked back to the equity wealth effect on spending. Now, I'll just make this one last point, which is this. There's another asset class that also bulks large on the household balance sheet, which is called residential real estate. And we just got the Case-Shiller numbers this week on home prices. They're down 4 months in a row. 4 months is already the start of a pattern. And what we found historically is housing leads the equity market. Residential real estate leads the equity market. There's a 90% correlation between residential real estate valuation and equity market valuation. We haven't seen this play out yet. But I said this, Ed and I debated a lot back in 2006, 2007. I said for the record back then, and back then it wasn't about AI, it was about the democratization of finance and the fact that everybody can go and buy a home. At that point, the supply-demand curve started to shift, as they're doing right now in residential real estate. I said then, I'll say now, no cycle ever ends well. And this took time to play out, but it played out big time. No cycle ever ends up well in a real estate deflation cycle. And this thing just started getting going 4 months ago.
Okay, great. Let's give Dr. Ed a chance to respond to that.
Yeah, look, a few things. Again, I think I put a lot of weight on the importance of, let's say, 70 million people that are baby boomers. They are increasingly retiring. They're sitting on $80 trillion of net worth. I predict that the savings rate is going to turn negative. You got all these people that are retiring. They're not going to be getting income anymore. So you could have some weakness in disposable income because baby boomers tend to make more, live long and prosper. They they've lived long, they've worked a long time, they're making a lot of money, and as they retire, that money is not going to be earned anymore. But they will be spending an enormous amount of their net worth, and there'll be inheritances, and there's support going on right now. And I think you really have to factor that in. I think you're right. There's a lot of things going on with the consumer, and I think that's where I'm putting my weight of thinking about the consumer. And as you pointed out, the second quarter real GDP, when it first came out, was clearly kind of an upside reversal from the weakness we saw in the first quarter related to the tariffs impact on imports. But then the upward revisions that occurred last week from 3.3% to 3.8% for the second quarter were awfully impressive, and the consumer went up from 1.6% to 2.5%. So the consumer is still spending. And then on Friday of last week, the Atlanta Fed came up with its latest estimate for the growth of the economy in the third quarter, and it's running around 3.8%. 3.9% was what they came up with, but then the latest revision is 3.8%. Maybe I tend to accentuate the positives, but I think if you've got GDP being revised up and it's growing at over 3%, and you've got the employment numbers being revised down, that must mean productivity is absolutely on fire. And I think there's a fundamental labor shortage in the economy. I think you're right. It's not just supply. There's also a demand issue. And I think we have to seriously consider the possibility that companies are holding off on expanding their payrolls until they figure out what they might be able to do with AI to eliminate position or entry-level positions. And right now we know that the where the labor market is weakest is in teenagers, and particularly young people coming out of colleges are finding it very, very hard to get an interview. So I think that companies are responding to that by using AI to increase their productivity, and the demand's holding up. The Fed has this dual mandate, and they are going to give more weight than I would give to the labor market indicators at this point, because Powell did acknowledge that there's some funky things going on in the labor markets. Supply is going down, and demand is going down. So you're right. It's not just supply, David. But when I look at these labor market indicators, I say, this is the consequence of that we're seeing fewer babies being born. Now we got a real slowdown in the native born population, and on top of that, as you said, we've got I think the population of foreign born from March to August, just a very short period of time, is down 1.5 million. So that's clearly had an impact. But there are technologies, there are ways to kind of regroup your business in a way that allows you to increase your productivity and satisfy the demand. I mean, businesses are doing well. Earnings all-time record high for the S&P 500. And we've looked at it, Magnificent Seven versus what I call the impressive 493. And the impressive 493 are also very strong. Profit margins have held up remarkably well in the face of tariffs. And again, that can only be explained, in my opinion, by the productivity and having an impact on those profits. So put it all together, I think David certainly gave a good analysis from where things could go wrong or are going wrong. And I respect David's analysis of the business cycle. There's a lot to it, but frankly, I haven't put as much emphasis on residential real estate. I think there's home prices are still extraordinarily high. There's been a tremendous positive wealth effect from real estate and the stock market. But David, at the end of the day, if whatever it is causes the stock market to tank, there will be a negative wealth effect. And that may be what causes the next recession a big negative effect from the stock market, but that's not my story.
Yeah, I don't know if the stock market's going to tank or not. As I said at the beginning, I just don't invest. I don't tell people what to do. I tell people what I'm doing. I don't invest in Two Sigma events unless it's coming off a depressed bottom. So, and based on our work, that's where we are right now, acknowledging that Bob Farrell's classic rule that exponentially rising markets go further than you think, but they don't correct by going sideways. I have a couple of concerns. The first is that, when I hear about asset prices, I hear about wealth. But asset prices in the United States, you go back a century's worth of data, it's always high. Even in recessions, it's high. Wealth is always high. Ultimately, though, it's the direction that influences growth, not the levels. And I have a problem. I had a problem back in 2000, and nobody saw a recession in 2001. And I had problems in 2007, and nobody saw a recession in 2008. I have a problem with getting to this stage of the cycle where asset prices are driving so much of what's happening in the economy, in particular, the fabled wealth effect. And as I said before, GDP indeed, so Ed says 3.8 and 3.8. 3.8 is Scott Besant's favorite number right now. GDP is spending. It's not the only measure of economic activity. GDP is spending, consumer spending, business spending, housing, exports, government spending. But what about income? This is not an economy driven by organic income. I finished saying before, because this is the statistic nobody knows. Everybody knows 3.8. Nobody knows that over the past 4 to 5 months, real disposable incomes in the United States. This is where you want to talk, David Lynn, about what is the labor market doing. The labor market is spitting out a negative 1.2% annualized trend since April in something fundamental called real personal disposable income. So yes, everything Ed's talking about is feeding into something we've seen at the peak of other cycles, which is this wealth effect driven decline in the savings rate to promote consumer spending, of course, in a certain slice of it, which is the high end. So I just don't look ever at headline numbers. I got to dig deep to find out what is the stability behind those numbers? What is the proportionality? What is the distribution? And I look at the stock market, for example. I see it extremely concentrated, just as it was. The earnings are concentrated. The market capitalization is concentrated to an extent that it was back at the peak in early 2000, a peak that nobody ever knows it's a peak till you're reading about it in the history books. So we're not going to talk about it right now, obviously. We're not in the history books just yet. And, Ed talks about the demographics. Look, we have a situation where, and this is what's driving the market, is a lot of the momentum and the bull market and passive index investing. Passive index investing. We have a situation now where passive index funds, for the first time ever, account for more than 50% of the market cap. They've overtaken active. And now a lot of the active managers are becoming index managers because it's been working. And you're getting these flow of funds coming in, and these index funds have to buy the market. It's this self-reinforcing development. But it's gone to another extreme, which is, and of course, people think that they're smart, that 72% of the US household financial asset mix is now in equities. Only 8% is in bonds. Who's going to talk to you at the cocktail party if you want to talk to the treasury market? They're going to avoid you like the plague. But we've never had this degree of concentration before of index funds, passive investing. We've never had this degree of concentration of household financial assets in the stock market. But it's certainly worked. But you see, the thing is that nobody in this cycle has rebalanced their portfolio. And there's been, I guess Ed might say, no reason to, but they've not rebalanced, they've not taken profits, and they've not diversified. I find that actually rather chilling. But nobody really wants to hear that story, but they might want to 1 or 2 years down the road. That the boomer, over 60% of boomer financial assets are in the stock market, and that's just been great. However, the time cycle of investing historically would warrant that they should be closer to 40% equities than 60. Time is not on their side, notwithstanding the fact that life expectancy is going up. And the fact that life expectancy is going up means that their money is going to have to work longer for them once they retire. And here's the problem, is that all are two standard deviation events in the market. This is much more, I do call it a bubble, and Jeremy Grantham would agree that anything more than a 2SD event is a classic bubble. We are in a price bubble, and it can go on further. But I'm worried about when the bubble does pop, because we know historically that bubbles pop. Even bubbles premised on a phenomenal shift in the technology curve. And we've had multiples of these over the centuries. Bubbles. So let me just finish. Let me just finish this last point, which is this: the median age of the boomer at the peak of the bubble in March 2000 was 40. The median age of the boomer today is 60. Okay, time at least was on their side back then, and I'm wondering, actually, unless the market cycle has been fully repealed, which I don't believe, what happens in the next bear market whenever it starts? What is going to be the social impact, especially on this critical demographic that's driven everything in the past 5 decades, from the economy to finance to politics? That to me is something that we should be talking more about than 3.8 on the last GDP print.
Right. Let's get Dr. Ed to respond, and I'll add to a question to that, if I may, Dr. Ed. Suppose David is right in his assessment that we're currently in a bubble and the markets are so concentrated that it becomes a risk in itself. Ultimately, where do investors go in an environment where things are looking frothy and bubbly and there's a huge concentration risk? And I'll let you respond to the rest of it.
I mean, weren't we all saying that or thinking of that at the end of last year, at the beginning of this year? I mean, we were looking at a 22 multiple at the beginning of the year. And then we had a correction, and the correction didn't lead to a recession. The correction didn't lead to a drop in real GDP. It was just a correction. And we had a bear market not too long ago, back in 2022, and it was kind of a garden variety bear market. Didn't last very long, and there was no recession associated with it. So I think that there are certainly aspects of a melt up. There's certainly aspects of a bubble. But I think the economy and the credit markets are much more resilient now, so that the implications aren't what they were in the past. I think we could very well see a significant correction sometime next year. It might be from a 23, 24, 25 multiple. And that could be fairly concerning. But so was the correction we had at the beginning of this year. And then we had this remarkable V-shaped recovery as the market started to recognize that some of the concerns about the hyperscalers spending too much money on data centers, maybe we've already kind of had that concern, and because of DeepSeek, and the market saw that these hyperscalers were convinced that they were onto something and that they were going to continue to spend. So I'm not quite sure what is going to be unique about the bubble bursting situation that David's talking about, when we just kind of burst the bubble for a little while and it didn't last very long, and we didn't have any long-term consequences from it. The credit markets are extremely resilient. We no longer depend as much on the banks. When asset prices fall, they don't lead to a credit crunch the way they did in the past. We just saw that the tightening of monetary policy created a problem in two banks in California a couple of years ago. And the response of the Fed was to provide liquidity, and the result was no credit crunch and no recession. So the two words I think that are relevant here is resilience of the economy and backed up by the capital markets, and productivity, which I think is very much technology driven. And I think that's what the market's discounting.
Dr. Ed, let me just ask you one follow-up, and I'll move on to David here. This is from the World Economic Forum. It says here, the companies such as NVIDIA, Microsoft, Amazon, the Mag 7 have collectively spent $36 billion on CapEx over the last 4 quarters, whereas the quarterly average for a typical S&P 500 company is $2 billion. Is there a historical precedent for one sector contributing to the majority of spending in the entire market?
Yeah. Well, look, over 40% of the market capitalization of the S&P 500 is information technology and communications. That's I think it's 44%. I think we got up to 40% during the tech bubble of the late 1999 environment. And back then, only 25% of earnings were attributable to those two sectors, and now it's more like 35%. So there's more earnings behind the concentration that we're seeing. And I think we have to recognize that we've been in a digital revolution since the mid 1960s when the IBM mainframe proliferated. And that digital revolution, AI is just it's an evolution in the revolution of the digital revolution. What's going on is we are processing more and more data more cheaply and more rapidly than ever before. And as a result of that, it's feeding on itself. And I think we're all trying to figure out how to use AI in our businesses. And I think a lot of us are finding that it's got some flaws, but it's early on. And meanwhile, we're finding that it's actually quite useful. And I think that's what we're going to discover here is that the digital revolution has evolved to the point where it's making a significant difference. I have to believe there were points in the agricultural revolution centuries ago, the industrial revolution, the retailing revolution, all these revolutions where suddenly you had two sigma events, and they were justified by the consequences of the revolution on business and on the economy.
David, on investments, in one of your recent special reports entitled "Investing in the Mega Forces Economy," the opening line was structural forces like AI, decarbonization, and demographics are becoming bigger drivers of change than the traditional big business cycle. I'll let you comment on that, and especially the AI front. Jeff Bezos himself, earlier today, this is according to CNBC, has admitted that it's starting to look like an industrial bubble. These are his words. It's kind of like an industrial bubble. He did go on to say that this is real. It's going to bring big benefits to society. I'll let you expand on how these themes are investable.
Well, I think that he's 100% right, and I've been talking about the fact that again, just looking at the valuations, what's priced in. And I think that, I think AI, just like the internet, generative AI is going to be a game changer. I see for society, there's more risks than there were just, with the internet, which at the beginning was just a way to improve our communications and the way that we shared information. AI, as I think probably already seeing it, more pernicious societal effects. But I said before that I'm just taking a look at the deviation of valuations. And I think that's really what's important here. That, Ed had said that, we had this recession scare and the regional banks and nothing happened. It was a blip on a screen, and he's right for saying that. Where I differ probably is I'm not extrapolating those events from what's going to happen in the near future, okay? Because you would have said after the October 1987 stock market collapse And remember, there was fears of depression. I started in the business in October of 87. There was fears of a depression that quickly went away within a couple of months. And then this mentality grew into the peak of the bull market in 1989 that the business cycle has been repealed. But it wasn't. And a lot of people were pointing to the proliferation of the computer age because remember, Microsoft went public in 1986. And then we had in 1998, for example, escaped a bullet with the Asian crisis, the Russian default, and of course, long-term capital management. And then we had the same thing. We had the same mentality that, wow, we avoided a recession. Therefore, we're not going to have a recession again. And not only that, we'll not have a bear market again. And it was within 2 years. People were caught off guard because they were extrapolating things that happened in the previous cycle. You go back to all those times, and I was at Merrill, and I was debating Ed quite regularly back then. At the beginning of 2007, you had New Century Financial. The canary in the coal mine closed its doors. He was a mortgage lender. And the market didn't peak till October of that year. And people said, well, you know, in that interim period, I mean, there's no problem here. We escaped something pernicious, and therefore there's a new era here where because this happened, the business cycle's been repealed. In fact, you can even go, the recession started, to the surprise of a lot of people, in December 2007. That's when the recession started, but Bear Stearns didn't close its doors until February of 2008. Now, at that period of time, people were still talking about the soft landing. After Bear Stearns closed its doors and was mopped up by Jamie Dimon, the view was that, wow, you know, we avoided a bullet here and that the business cycle's been repealed. Meanwhile, we were already 3 to 4 months in a recession. And people thought that we just were in a correction and not a bear market. Well, that view changed obviously in the summer of 2008. I'm just talking about here the dangers of extrapolation. Yes, we wrote a long-term report.
David,
yeah. So
David,
the dangers of using data points from the cycle to then formulate your forecast on what's going to happen next, that sends chills down my spine. I think that what I'm looking at now, yes, there was no recession in 2022, 2023. That $2 trillion of stimulus checks, the quotes excess savings, was still being put to work. It's the first time ever that 100% of a government handout, $2 trillion, got fully put into the economy. That was a massive antidote to what the Fed was doing. And the point I'm making is that it comes down to David Lynn's comment before. Either we're going to admit that the labor market is a very important market. It generates most of the income in the economy, not corporate profits, but personal income. And there's some derivative impact on corporate profits from personal income. We were not seeing employment going down. And employment, right. Now we don't have the non-farm payrolls. You look at the household survey, employment's going down. You look at the non-farm pay, you look at the ADP numbers, employment's starting to contract. You look at real disposable income, it's negative over the course of the April to August period for where we have data. I mean, real personal incomes are going down. They were not going down in 2022. They were not going down in 2023. They're going down right now. And it's a negative trend that's building on itself. I'm sure when we finally get the September and October data, the negative trend in real PDI is going to be even worse. And there are repercussions for that on the broad economy. Unless we're going to say we're going to run this economy on asset inflation to perpetuity, we have to step back and say that organic personal income is actually not just on a declining trend, but is contracting.
Okay.
And there are leading economic effects from that I don't believe are priced in. Ed made the point about credit spreads. Good grief. They're back to where they were in the party period of 1998-99. Yeah, the credit market is telling you there's nothing wrong. But the credit
It's
market
telling
was
you the
telling you there's
economy is
nothing. The credit
resilient.
market was telling you there was nothing wrong in 07 and nothing wrong in 99. The credit markets right now, like the equity market, are priced for almost 0% recession risk.
All right, we have to move on.
That's the dilemma I have right now, is how can anybody ever say at any moment in time that the business cycle's been totally repealed? You'll never hear that from me.
Okay, great. Dr. Ed, one final question from me, and then we'll close off. So same line of thought here. Investable themes here. I mentioned to David AI and a few other themes that he wrote down. What is it for you, given your macro outlook?
What is what?
What are the investable themes, or just generally speaking, assets allocation?
I've been I turned bullish on this market in early November 2022. I didn't think we were.
Is it the broad market that you're bullish on, or a specific sector that you like more than others?
Yeah. I'm getting there. I'm just saying, since then we've been recommending overweighting information technology, overweighting communication services, overweighting financials, and overweighting industrials, and they've all been working gangbusters just fine. And even if you look at the market excluding the Magnificent Seven, it's been a very good bull market. It's just been dominated by the Magnificent Seven, and I don't really have a problem with the concentration issue. So I would continue to look for opportunities in that market. I hope David's right, and we have an opportunity to get things a little cheaper. I don't mind corrections. I view them as buying opportunities. We're seeing that they don't seem to last very long, and I continue to bet on what I've been saying for 3 years now, and I continue. And I think we should learn from the experience of the past 3 years. This economy is resilient, and I think I'm not saying there's never going to be a recession, but David, I would point out that we've had rolling recessions. We've had a recession in multifamily housing, single-family housing, office buildings. On the other hand, we've had some real strength in manufacturing, production, building of manufacturing facilities, data centers. And I think the consumer is not all about asset inflation. I think it's about retiring people. We've never had a wealthier retiring sector than what we have right now with the retiring baby boomers. And I think that's what you're missing, David, is the resilience of the economy, the productivity of the economy. And with regards to your real disposable income, you're focusing on employment. Well, as you know, there's another variable that determines real purchasing power, real disposable income, and that's real wages. And if productivity does what I think, which is currently go from 2% to 3% over the rest of the decade, we'll see real wages increasing. Real wages are tied to productivity. That's still the case, and that's what I'm counting on.
All right, excellent. Let's end it here. This is all the time we have. Thank you very much to both of you, gentlemen.
Thank you, David.
Great talk. Before we go, tell us where we can find your work. David, I'll start with you first.
Sure. Well, you can just Google us at Rosenberg Research, or go to information at rosenbergresearch.com and check out our website. And you can check out the opportunity to press a few buttons and get a free trial to kick our tires.
Thank you. Dr. Ed?
Yardeni.com. That's simple.
All right. Very good. Thank you to both of you again. We'll speak again soon. And thank you for watching. Don't forget to like and subscribe.